Here's the truth. Most of us will wait until we're right at the doorstep of our retirement to start learning about income investing. I think that's a mistake. No waiting. As always, I'm giving it to you up front. Let me show you why with a quick piece of math. Imagine you take $100,000, put it into an index fund, and just leave it alone at a 10% annual return after 20 years. That can potentially grow to about $700,000. Now, what if you added $500 to it every single month? But here's the kicker. $500 isn't coming out of your pocket. It's being generated by the income ETFs. Over that same 20-year period, your total grows to over $1 million. That's a $300,000 difference. All because you started using income-generating tools way before retirement. Currently, I use 3 specific ETFs to generate that kind of income. First, SGOV, second, SPYI, and third, QQQI. SGOV. I think of this as a safe harbor. It invests in short-term US Treasury bills, its low volatility preserves my capital, it earns a steady 4% yield. Nothing fancy, I know, but the stock price is incredibly resilient. This makes it a good alternative to just holding cash. I never liked bonds myself because they can trend down over time and stay where they fell. But short terms have been good to me so far. Now, let's talk about QQQI and SPYI. These are my income engines. Both use a covered call strategy. QQQI on the Nasdaq side with 13.5% yield, and SPYI on the S&P 500 side with 12% yield. Both use Section 1256 options for potential tax efficiency and providing me exposure to 2 of the market's most widely followed indexes. Combined, these positions generate me about $1,000 in extra income for my portfolio every single month. I hit 3 objectives. First, I generate cash I never had to work for. Second, I boost my overall returns by reinvesting this generated capital into my ETFs in a base layer or my core stocks. And third, I learn about the product and how it works way before retirement. You have to be realistic. These funds are special and they behave differently. They shine in flat and moderately rising markets, but if we hit a massive bull run, what happens? They tend to underperform the underlying index because you are trading some of that upside for generous income. What happens in a sharp downturn? They'll cushion some of the blow, but they won't completely save from the drop. This is my structure to put it all in perspective. First is the base, Bros Index funds. This is my foundation. Second is the core, high conviction growth stocks. Third is my income layer. Next time, I'm going to break down the final layer, the moonshots, those high risk, high reward positions that I use to add a little bit of extra juice to my total returns. If you want to see how that fits into the full picture in greater details, join my Patreon at Investor HIQ. This is not financial advice. Always do your own research before you purchase any investments. See you at the next one.